Welcome back, students. In this lecture, I will be talking about the perpetual inventory system, and specifically, I will be talking about how purchase is recorded under the perpetual inventory system. In order to understand the perpetual inventory system better, we need to remember three things. First of all, the merchandising companies, they buy the inventories either on cash or on credit. So we can have either of the transaction. It can be either in cash or on credit. And depending on that, we will treat that specific transaction when we record it. Next, we have to remember that merchandising companies only record the transactions when they receive those inventories from the seller. So the point in time when it is being recorded is also important in order for us to understand the impact of the transaction. And lastly, in case of recording the transaction, it is very important that we have a business document to back the transaction. And in case of purchase of inventory under the perpetual inventory system, is the purchase invoice that will be the business document to back the transactions in this case. As we said in the last slide, that in order for a transaction to be recorded in the books of a merchandising company, they need a business document to back that up. And in case of purchase, it is the purchase invoice. So here we have a real life purchase invoice where you can see it starts with the name of the seller and then it is written sold to. So this is the part where the buyer's detail is given, and then you can see this is the date when it is sold. Then you have the specification of the products that's been sold, the quantity, then the price, and by multiplying the quantity with the price we have the amount that's there, and this is the total amount of the purchase. Now, if we try to journalize the transaction that we just saw in the purchase invoice, we know that SOC Stereo was the buyer and the PW Audio Supply was the seller. So here we will be talking about SOC Stereo because we are now considering only the purchase side of it. So in case of SOC Stereo, they purchase some merchandise, so their inventory level is supposed to go up. And as you know, inventory is an asset. It is a current asset. So when we say inventory is going up, it means we are supposed to record it as debit, because whenever asset increases, we put it under debit. And in case of payment, what SOC is now paying is they're not actually paying the cash right at the moment, but just because they're not paying the cash, they're incurring a liability. So their liability is increasing. And as you know, when we have purchase on credit, we put it under accounts payable. So accounts payable is a liability and the liability is going up. So it should be under the credit side. So now if we look at the journal entry, we see that first of all we have to put the date, that's May 4th, and the inventory is debited at the amount of 3,800 and accounts payable is credited at 3,800. So since it is a purchase transaction, SOC Stereo has received inventory, so we put it under debit, and they will be paying some money in the future, so they're liable to pay, and that is why we have put it under credit. Here I will be talking about the freight cost, and by freight cost we mean the delivery charges. When a merchandising company purchases inventory from a seller, it is very important to understand who will be paying for the freight cost, whether it will be the buyer or the seller. And in case of freight cost, we have two very commonly used terms. One is the FOB shipping point and the other is the FOB destination. By FOB we mean freight on board. So in case of FOB shipping point, the seller places the goods free on board and the buyer pays for the freight cost. And in case of FOB destination, it is the seller who pays for the freight cost. And these terms have implication on the transfer of ownership as well. So in case of FOB's shipping point, we say that the ownership of the merchandise is transferred to the buyer as soon as the seller hands over the merchandise to the carrier or to the transportation company. And in case of FOB destination, the ownership of the merchandise is transferred to the buyer when the merchandise reaches the buyer's business center. So in case of FOB destination, the responsibility of the merchandise remains with the seller during the transportation process. In order to understand the freight cost better, we will be going through two transactions, one where the buyer will be paying for the freight cost and the second one where the seller will be paying for the freight cost. So in the first transaction, as you can see, Sock Stereo, who was the buyer, is paying public carrier company $150 for freight charges. So in case of buyers, when the buyer incurs transportation costs, these costs are considered as part of the cost of purchasing inventory. So in case of Sock Stereo, they are considering this freight cost as part of their cost of inventory. So when inventory increases, the amount is debited because inventory is an asset and asset is getting increased, so we will put it under debit side. And what Sock is giving away is cash. They're paying for the freight cost, so they are their asset, that is cash, this current asset, is decreasing. So when asset decreases, it should be under credit. So if we go through the journal, we see that on May 6th we have debited inventory and we have credited cash. Again, let me just tell you, when the buyer pays for the freight charges, they include that in the cost of inventory, and that is why we have debited inventory rather than putting freight charges here. And now let us see what happens if the seller pays for the freight cost. For the seller, freight cost is only an operating expense. It is nothing else than a regular operating expense. So for PW Audio, what they're paying is they're paying cash. So cash is an asset and it is decreasing as they're paying the money to a transportation company. So we will have to decrease the balance of cash, and how we do that is by crediting cash at an amount of 150. And for PW Audio Supplies, they are incurring some expense, and as you know, in our from our accounting equation, when expense increases, we put it under debit. So in case of PW Audio Supply, the journal entry will be freight out, or the delivery expense should be debited and cash should be credited, as they are incurring delivery expense, which is an expense, and it should, when expense increases, it is debited, and they are paying the cash, so cash is decreasing, that is a current asset, and when asset decreases, it should be under credit. As you know, the merchandising companies buy the products that they sell to its customers, and there can be times when they may not be happy or satisfied with the quality of the products that were delivered. It can be of inferior quality, or the specification may not meet the original order. So in these cases, the purchaser can return the goods for credit if the purchase was made on credit, or they can just return the goods and ask for a cash refund if they have purchased it for cash. However, in order to avoid it, the seller can also grant purchase allowance in order to convince the purchaser to keep the merchandise. And when a seller grants a purchase allowance to the purchaser, it enables them to pay a reduced amount of price to the seller at the due date. In order to understand the purchase return and allowance under the perpetual inventory system, let us consider two examples. Firstly, let us assume that Sock Stereo returned goods costing $300 to PW Audio Supplies on May 8th. So what is happening? Sock is returning some goods. That means their inventory is reducing. And on the other hand, since Sock is returning some goods, they will have to pay a certain amount less when they will be paying for the inventories. So in one hand, inventory is reducing. On the other hand, accounts payable is also reducing. So as you know, when asset reduces, it must be put under credit, and whenever liability decreases, it must be put under debit. So let us see the journal entry for this. So we have debited accounts payable for $300 and we have credited inventory for $300. It's just because inventory is an asset and it is getting reduced, and accounts payable is a liability and it is also getting reduced because we have returned the inventory, so we don't have to pay this amount in the future. Let us see another example. Assume that Sock Stereo was granted a purchase allowance of $50 and decided to keep the goods on May 8th. So here, what Sock has decided is to keep the goods because it has received a purchase allowance. So in this case, they will have to reduce the value of their inventory in hand, and at the same time, since they have received a purchase allowance, they will have to pay a certain amount less in the future. So in this case as well, we will be debiting accounts payable by 50 and crediting inventory by 15. However, you have to remember that here we have only credited inventory in order to reduce the value of inventory, but no physical transfer of inventory has happened in this transaction.